Hey everyone, welcome back to Asian Guy Analysis on 3rd February 2026. If you're new here, hit that subscribe button because today we're diving into something absolutely explosive happening in the markets right now. Silver just hit $87 per troy ounce on February 3rd, 2026. That's a nearly 10% jump in just one day. And here's the kicker. It's up over 171% compared to this time last year. We're talking about a massive rally that has investors, traders, and economists all asking the same question. What's driving this historic surge? And more importantly, where is silver headed next? In this video, I'm going to break down the key factors behind this rally, analyze the technical and fundamental drivers, and give you my perspective on what this means for the precious metals market. Let's get into it. All right, let's start with the raw data because these numbers are truly remarkable. As of February 3rd, 2026, silver is trading at $87.09 USD per troy ounce. To put this in perspective, that's up 9.95% from just the previous trading day. Think about that. A 10% move in a single day for a commodity that has been around for thousands of years. That's not normal volatility. That's a significant market event. Now, zooming out a bit, over the past month, silver has climbed 13.73%. That's strong momentum by any measure. But here's where it gets really interesting. Compared to the same time last year, silver is up a staggering 171.57%. We're talking about silver more than doubling in value, actually almost tripling, in just 12 months. And if we look at the all-time high, silver reached 121.64 in January 2026, just last month. So while we're not at that peak right now, we're still in historically elevated territory. Now, I'm using CFD data here. That's contract for difference trading, which tracks the benchmark market for silver. This gives us real-time insight into how the market is valuing this precious metal. These aren't just random numbers on a chart. These represent real shifts in supply, demand, economic policy, and investor sentiment. So let's break down what's actually causing this rally. Before we dive into the current drivers, I want to give you some historical context because understanding where we've been helps us predict where we might be going. Silver has always been known as the poor man's gold. It's more affordable than gold, but it's also more volatile. Throughout history, silver has had dual roles. It's both a monetary metal and an industrial metal. This dual nature makes silver unique and frankly more interesting than gold in many ways. If we look back at previous silver rallies, we can identify some patterns. The 1980 Hunt Brothers silver squeeze saw prices briefly spike to around $50 per ounce. Then we had the 2011 rally where silver hit about $48 during the commodities supercycle. Each time we saw a combination of monetary uncertainty, inflation concerns, and industrial demand driving prices higher. But what we're seeing now in 2026 is different. We've blown past those previous highs. The fact that silver hit $121 just last month and is still holding above $87 suggests this is not just a speculative bubble. There are fundamental forces at play. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. Historically, this ratio averages around 60-80 to 1. When it gets too high, silver tends to outperform gold as it catches up. The current rally suggests we might be in one of those catch-up phases, amplified by other factors we'll discuss. So what's actually driving this unprecedented rally? Let me break down the key fundamental factors. First, industrial demand for silver has exploded. Unlike gold, which is primarily used for jewelry and as a store of value, silver has critical industrial applications. We're talking about solar panels, electronics, electric vehicles, 5G technology, and medical applications. The global push toward renewable energy has been a game changer. Solar panels use significant amounts of silver for their photovoltaic cells. As countries race to meet climate targets and transition away from fossil fuels, demand for solar installation has skyrocketed. Each solar panel requires roughly 20 grams of silver, and when you multiply that by millions of installations worldwide, you're talking about serious demand. Electric vehicles are another major factor. EVs use almost twice as much silver as traditional combustion engine vehicles due to their electrical systems, charging infrastructure, and battery technology. As EV adoption accelerates globally, this creates sustained long-term demand for silver. On the supply side, we're seeing significant challenges. Silver mining is often a byproduct of other metal mining operations: copper, gold, lead, and zinc. This means silver supply is somewhat inelastic and can't quickly respond to price increases. Additionally, major silver-producing countries have faced operational challenges, whether it's regulatory issues, labor disputes, or geological challenges in accessing new deposits. The lead time to bring new silver mines online is measured in years, not months. So even if prices are high, supply can't instantly catch up. The macroeconomic environment is also playing a crucial role. Central banks around the world have been navigating a complex landscape of inflation management, economic growth concerns, and currency stability. When investors worry about currency debasement or inflation eroding their purchasing power, they traditionally turn to precious metals. Silver, being more affordable than gold, becomes an attractive option for both institutional and retail investors looking to hedge against economic uncertainty. If we're seeing persistent inflation or concerns about the stability of fiat currencies, precious metals become more attractive. The 171% year-over-year increase suggests investors have been increasingly viewing silver as a store of value and inflation hedge. Finally, we can't ignore the role of investment demand. The rise of silver ETFs, retail trading platforms, and increased awareness of precious metals as an asset class has brought new waves of investors into the market. Social media and online communities have also played a role in creating awareness and, at times, coordinated buying pressure. While I don't want to overstate this factor, it's clear that retail participation in commodities markets is higher than it's been historically. Now, let's talk technicals because the chart is telling us an important story. The 9.95% single-day gain we saw on February 3rd is what technical analysts call a gap up, or significant bullish momentum. This kind of move often indicates strong buying pressure and can signal the continuation of a trend. Looking at the monthly performance, up 13.73%, we're seeing sustained momentum, not just a one-day spike. This suggests underlying strength rather than mere speculation. The fact that silver reached an all-time high of 121.64 in January and is now trading at 87 shows we've had some consolidation. From a technical perspective, this could be healthy. Markets rarely move straight up without pullbacks. The question is whether 87 represents a new support level, or if we could see further downside before the next leg up. Key resistance levels to watch would be around 90, 100, and then that all-time high at 121.64. On the downside, support might be found around 80, and then the psychologically important 75 level. The volume and volatility we're seeing suggest strong participation from multiple types of market participants: industrial buyers, investors, traders, and speculators. High volatility can present opportunities, but also risks, so risk management becomes crucial here. One interesting pattern is the relationship between silver and other assets. Typically, when equity markets face uncertainty, precious metals benefit. If silver is rallying while stocks are struggling, that tells us one story. If both are rallying together, that tells us something different about underlying economic confidence. Now, I always want to present a balanced view, so let's talk about the risks and potential headwinds for silver. First, as we've seen, silver is incredibly volatile. That 171% gain year over year is impressive, but silver can also decline just as dramatically. The drop from 121 to 87 that is about a 28% decline from the peak in just a month. This volatility can create opportunities, but also significant risks, especially for those using leverage or derivatives. If we see a global economic slowdown, industrial demand for silver could soften. Remember, roughly 50% of silver demand comes from industrial applications. An economic recession could reduce manufacturing activity, electronics production, and even slow the pace of renewable energy installations if financing becomes more challenging. Technology evolves, and there's always the risk that alternative materials could replace silver in some applications. For example, researchers are constantly working on more efficient solar cell designs that might use less silver or substitute materials. While this is a longer-term concern, it's worth considering. If central banks successfully bring down inflation and real interest rates rise significantly, the opportunity cost of holding non-yielding assets like silver increases. This could reduce investment demand and put downward pressure on prices. Changes in trading regulations, margin requirements, or tax treatment of commodities could impact investor appetite for silver. Additionally, any major changes in the ESG considerations around mining could affect supply dynamics. Silver mining is concentrated in certain regions. Mexico, Peru, China are major producers. Any geopolitical tensions, trade disputes, or regional instability in these areas could impact both supply and investor sentiment. So, what should investors take away from this silver surge? First, silver represents a diversification opportunity within a broader portfolio. Its low correlation with traditional stocks and bonds can provide balance, especially during times of market stress or currency concerns. However, diversification doesn't mean going all in on any single asset. Even if you're bullish on silver, position sizing and risk management are crucial. A 171% gain is exciting, but the volatility that comes with it requires careful consideration. The underlying industrial megatrends, renewable energy, electrification, digitalization, are likely to continue. These aren't short-term fads, but rather multi-decade transitions. This suggests sustained demand for silver beyond just investment or speculative interest. For investors with a longer time horizon, silver exposure might be a way to participate in these technological and energy transitions. If inflation remains a concern, And many economists suggest that the structural forces creating inflation have not fully dissipated. Precious metals continue to serve their traditional role as inflation hedges. Silver, being more affordable and accessible than gold, might be particularly attractive to retail investors looking for this protection. The challenge, of course, is timing. After a 171% run-up, is this the right time to enter? That's the million-dollar question. One approach is dollar cost averaging, gradually building a position over time rather than trying to time a single perfect entry point. This smooths out volatility and removes some of the emotional pressure of trying to catch the exact bottom. Another consideration is the form of exposure. Physical silver, ETFs, mining stocks, and futures or options all offer different risk-reward profiles. Physical silver provides direct ownership but comes with storage and insurance costs. ETFs offer liquidity and convenience. Mining stocks provide leveraged exposure but also company-specific risks. Derivatives offer the most leverage but also the highest risk. Short-term traders might look to capitalize on the volatility we're seeing, but this requires active management, technical skills, and risk controls. Long-term investors might view silver as a strategic allocation, a portion of their portfolio dedicated to hard assets and inflation protection, regardless of short-term price movements. The key is aligning your silver exposure with your overall investment objectives, time horizon, and risk tolerance. All right, let's wrap this up. Silver surged to $87 per troy ounce, up nearly 10% in a single day and 171% year over year, is one of the most significant moves we've seen in the commodities market. This isn't just about speculation. There are real fundamental drivers at play. Industrial demand from solar, EVs, and technology is creating sustained appetite for silver. Supply constraints mean the market can't quickly adjust to meet this demand. And macroeconomic concerns continue to drive investment demand for precious metals as inflation hedges. The technical picture shows strong momentum, though we've seen some consolidation from the January peak at 121. Key levels to watch are around 90 on the upside and 80 on the downside. But with opportunity comes risk. Silver's volatility, potential economic headwinds, and the possibility of policy changes all represent real considerations for anyone thinking about exposure to this market. My takeaway? Silver represents an interesting opportunity, particularly for those looking to diversify their portfolios and gain exposure to long-term industrial megatrends. But, as always, position sizing, risk management, and alignment with your overall strategy are essential. What do you think? Are you bullish or bearish on silver from here? Let me know in the comments below. And if you found this analysis valuable, smash that like button and subscribe to Asian Guy Analysis for more deep dives into markets, economics, and investment opportunities. Until next time, stay informed, stay diversified, and keep analyzing.